You owe taxes on the income you earned anywhere in the globe as a US citizen. The majority of people invest in cryptocurrency. Cryptocurrency is frequently considered as a capital asset under current Internal Revenue Service virtual currency criteria. This implies you will have to pay capital gains tax on it. Cryptocurrency can also be used to earn money, which we'll go into in more detail later. Depending on the type of capital gain, you must pay capital gains taxes. The two forms of capital gains are short-term and long-term, and they are determined by how long you retain the asset, in this case, Bitcoin. Hey everyone, welcome back to our channel. In this video, we will be talking about 7 tips to avoid cryptocurrency taxes legally. And before we start, make sure to hit the subscribe button and turn on the notification bell. Done? Let's get started then. Cryptocurrencies are a great investment in both short-term and long-term gains. Short-term capital gains occur when you sell Bitcoin for a higher price than you paid for it after holding it for a year or less. These, like wage income, are taxed at the taxpayer's ordinary income tax rate. When you sell cryptocurrencies for more than you paid for it, but keep it for more than a year, you earn long-term capital gains. These profits are subject to lower long-term capital gains tax rates, which can be as low as 0%. It's important to keep in mind that virtual currencies are still in their infancy, and the IRS or Congress may change its minds about crypto taxes in the future. However, given how Bitcoin is currently taxed, there are a few methods you might be able to help decrease or eliminate any potential taxes you may owe. Number 1. Invest in cryptocurrency through the IRA. By acquiring Bitcoin in a self-directed IRA, you may be able to invest in cryptocurrencies tax-free. Most IRAs allow you to invest in traditional investments such as stocks, mutual funds, and ETFs. Self-directed IRAs are a type of IRA that allows you to invest in unusual assets like Bitcoin, precious metals, and real estate. To begin, you will need to locate a self-directed IRA that allows you to invest in the cryptocurrency of your choice. Before you go, make sure you understand how to acquire Bitcoin in the self-directed IRA of your choice. Your tax benefits will vary based on your tax situation and the sort of IRA you open and contribute to once you've set up an account. Traditional IRAs may allow you to make tax-deductible contributions, but withdrawals in retirement will be subject to ordinary income taxes. Roth IRAs require you to contribute after-tax money to the account, but they allow you to take funds tax-free in retirement if you satisfy certain criteria. Check out our guide to Roth versus traditional IRAs for more details. Number 2. Relocating to Puerto Rico. If you have a lot of cryptocurrencies, moving to Puerto Rico could help you avoid paying some federal income tax in the United States. Puerto Rico is a U.S. territory with special tax advantages, including a complete exemption from capital gains taxes. As a result, whether you are wanting to save money on crypto or avoid capital gains on stocks, moving to Puerto Rico might save you a lot of money on taxes. However, this method isn't as advantageous as it appears. To be eligible to file your taxes in Puerto Rico, you must first become a legal resident of the island and retain that status. Furthermore, any cryptocurrency gains made prior to migrating to Puerto Rico and establishing bona fide resident are still taxable in the United States at the corresponding tax rates. Because this method is so complicated, you should seek advice from a tax professional before implementing it. Number 3. Declare your cryptocurrency as a source of income. Taxation differs depending on whether you receive cryptocurrency in return for products and services or mine cryptocurrency. When you get cryptocurrencies in certain situations, it is recognized as income. You must keep track of the fair market value of the Bitcoin you got and report it on your tax return as income. This income is taxed at standard income tax rates when you report it. These are greater than the rates on capital gains. The amount you record as income for the cryptocurrency you receive is your basis, a tax phrase that refers to the currency's initial worth when you received it. When you eventually sell the cryptocurrency, you will use that basis to calculate any capital gains and pay any capital gains taxes due. This is also true when it comes to Bitcoin mining. Cryptocurrency mining, on the other hand, is typically regarded as self-employment activity. This means that in addition to regular income taxes, you will have to pay self-employment taxes. Number 4. Keep your cryptocurrency for the long haul. You normally do not owe taxes on cryptocurrencies until you sell it if you are holding it as an investment and it is not making any revenue. You can completely avoid paying taxes if you don't sell any during a given tax year. However, you may wish to sell your Bitcoin at some point. Make sure the Bitcoin you sell has been held for more than a year to reduce your tax burden. If it has, you may be eligible for lower long-term capital gains tax rates on your cryptocurrency sale. It's possible that you will save a lot of money on your taxes as a result of this. Number 5. Balance out your cryptocurrency earnings and losses. You make a profit or a loss when you sell an investment, which you realize is determined by the price you paid for the asset and its cost basis. The good news is that capital gains and losses can be used to offset each other under the US tax rules. Tax loss harvesting is when you consciously use this to your advantage. Gains and losses of the same type offset each other first in terms of technicality. Short-term gains would offset short-term losses, and long-term tax items would do the same. Then you can use a net gain of the other type to offset any ensuing net loss. Consider the following scenarios: a $1,000 short-term loss, a $2,000 short-term gain, a $3,000 long-term gain, and a $5,000 long-term loss. You'd make a $1,000 net short-term gain and a $2,000 net long-term loss in this situation. Then you would subtract these figures from each other to arrive at a net $1,000 long-term loss. You can claim up to $3,000 if you had a total capital loss for the year. Any remaining loss can be carried over to subsequent years. Many of the finest robo-advisors allow investors to automatically harvest tax losses. Number 6. Sell assets during a year with a low income. Whether you have a short-term or long-term capital gains, the tax rate you pay is determined by your income. Your tax rate will be reduced if your taxable income is low. You may be able to save money on taxes by selling cryptocurrencies that you anticipate will appreciate in years when you will be paying taxes at a lower rate. Selling cryptocurrency might result in some of the income being taxed at a higher rate, but that does not push all of your income into a higher tax bracket as many people believe. Number 7. Donate to charity. Donations to a qualified charity may be tax deductible if you itemize your deductions. To qualify, you must have held the asset for at least 1 year before donating it. Donating property such as cryptocurrency might result in favorable tax treatment. You typically get to deduct the fair market value of your cryptocurrency, but you should not have to pay capital gains taxes when doing so. The amount of the deduction is limited, so consult your tax advisor to see if a donation will help you save money on your taxes. Depending on your circumstances, several countries do not charge taxes on Bitcoin transactions. Germany, Singapore, Portugal, Belarus, and Switzerland are among these countries. They may tax corporate cryptocurrency income or cryptocurrency in some other way, so it's crucial to speak with a tax advisor about it. Tax rules are always changing, so you must stay up to date on any changes. While several governments do not levy a tax on cryptocurrencies, this does not benefit Americans. Citizens of the United States are taxed on their worldwide income, which includes Bitcoin gains. To avoid this international income tax, you would have to relinquish your US citizenship. If you buy crypto assets before they skyrocket in value, you might be able to make a lot of money. If you are fortunate enough to have this happen to you, a little tax planning could help you lower the amount of money you owe in taxes on your crypto gains. When dealing with a tax professional, the list of suggestions above may be useful. If you enjoyed this video, please check out our other videos. Until then, stay tuned.